Currency Chemistry: Unlocking 21 Lucrative Relationships in Forex Trading. Mastering Holistic Currency Dynamics for Profound Trading Success. Written by Prathyush P. Gopinathan. Narrated by iVoices. Disclaimer: the information provided in Forex Dynamics, Mastering the Thrilling World of Currency Trading, is for educational and informational purposes only. While the content aims to provide insights into the foreign exchange market and trading strategies, it should not be construed as financial advice or a recommendation to engage in trading activities. Trading foreign exchange carries a high level of risk, and it may not be suitable for all investors. Past performance is not indicative of future results, and there is no guarantee of success in the Forex market. Before making any trading decisions, readers should carefully consider their financial situation, risk tolerance, and investment objectives. The authors, publishers, and contributors of Forex Dynamics do not assume any responsibility for any losses or damages resulting from the use of the information presented in the book. Readers are encouraged to consult with a qualified financial advisor or broker before engaging in any trading activities. Additionally, please be aware that regulations and laws regarding Forex trading may vary by jurisdiction. It is the responsibility of readers to ensure compliance with all applicable laws and regulations in their respective countries or regions. By reading Forex Dynamics, readers acknowledge and accept the inherent risks associated with trading foreign exchange and agree to release the authors, publishers, and contributors from any liability arising from their trading decisions. Introduction: the allure of Forex trading lies in its dynamic nature, a constant dance of currencies influenced by a multitude of factors. While technical analysis, deciphering charts and patterns, holds undeniable value, it's merely a single brushstroke on a vast canvas. To navigate the complexities of this market and unlock true potential, traders must become adept at interpreting the broader macroeconomic landscape. Imagine the Forex market as a colossal puzzle. Each currency pair represents a piece, and successful trading hinges on assembling this intricate picture. Focusing solely on individual technical patterns, akin to fixating on a single puzzle piece, blinds you to the bigger picture. Unforeseen macroeconomic shifts, like a sudden change in interest rates or a geopolitical crisis, can then easily derail your strategy. This is where the power of a macroeconomic perspective shines. By delving into the world of economic indicators, policies, and global events, traders gain invaluable insights. They learn how factors like gross domestic product, GDP, growth, inflation rates, and central bank interest rate decisions influence the relative value of currencies. Imagine each economic data release as a new puzzle piece, revealing a clearer picture of potential currency movements. This newfound knowledge empowers informed decision-making. Traders can anticipate how an unexpected rise in inflation might weaken a currency, prompting them to adjust their positions accordingly. The risk of being blindsided by sudden market shifts diminishes significantly. The key lies in achieving a harmonious balance. Microeconomic analysis, focusing on specific currency pairs and their technical characteristics, remains a crucial tool. However, it's the macroeconomic backdrop that dictates the overall market direction. Examining factors like trade imbalances, government debt levels, and global risk sentiment allows traders to identify underlying trends and position themselves strategically. Mastering the language of macroeconomics equips traders with a sturdy foundation. It's the bedrock upon which successful Forex strategies are built. Here's a roadmap to navigate this essential knowledge. Economic calendar mastery. Become intimately familiar with upcoming economic data releases, such as interest rate decisions, inflation reports, and employment figures. These releases can significantly impact currency valuations. Central bank policy analysis. Central banks play a pivotal role in influencing currency values. Understanding their monetary policy stances, whether dovish, accommodative, or hawkish tightening, is critical. Geopolitical awareness. Global events, from trade wars to regional conflicts, can have a ripple effect on currency markets. Stay informed about major geopolitical developments and their potential impact. Global interconnectedness. The Forex market is a web of interconnected currencies. A strong understanding of how economic data and events in one region can influence currencies in another is paramount. By incorporating a macroeconomic perspective into their trading toolkit, Forex participants unlock a world of opportunity. The ability to anticipate market movements based on a broader understanding of economic forces empowers them to navigate the complexities of the market with greater confidence and potentially achieve sustainable success. Remember, the Forex market is a dynamic puzzle, and the key to unlocking its secrets lies in wielding both the technical and the macroeconomic brushstrokes. Introduction. Currency pairs are the cornerstone of the foreign exchange, Forex, market, representing the comparative value of two different currencies traded against each other. In Forex trading, currencies are always quoted in pairs, with each pair consisting of a base currency and a quote currency. These pairs serve as the foundation for conducting transactions and speculating on the fluctuating values of global currencies. Understanding the dynamics and intricacies of currency pairs is essential for traders seeking to navigate the complexities of the Forex market and make informed trading decisions. Whether it's analyzing economic indicators, geopolitical events, or market sentiment, currency pairs serve as a vital tool for assessing and interpreting the ever-changing landscape of international finance. A simple anatomy. Currency pairs are combinations of two different currencies traded against each other in the foreign exchange, Forex, market. They form the basis of Forex trading, enabling participants to speculate on the relative value of one currency against another. In Forex trading, currency pairs are quoted in pairs, where each pair consists of a base currency and a quote currency. The base currency is the first currency listed in the pair and represents the denomination of the transaction. On the other hand, the quote currency is the second currency in the pair and indicates the value of one unit of the base currency. Significance. Understanding currency pairs is crucial for Forex traders as they provide insights into the relative strength and weakness of currencies. By analyzing currency pairs, traders can make informed decisions about buying or selling currencies based on factors such as economic indicators, geopolitical events, and market sentiment. Base currency and quote currency. In a currency pair, the base currency is the currency against which the exchange rate is quoted. It represents the amount of the quote currency required to purchase one unit of the base currency. The quote currency, on the other hand, is the currency in which the exchange rate is quoted. It denotes the value of one unit of the base currency. Analyzing Euro to US dollar. Euro to US dollar is one of the most widely traded currency pairs in the Forex market, representing the euro as the base currency and the US dollar USD as the quote currency. In this pair, the euro is the base currency, and the exchange rate indicates the amount of US dollars required to purchase 1 euro. The significance of euro to US dollar lies in its representation of the economic dynamics between the Eurozone and the United States. Traders often analyze this pair to gauge the relative strength of the euro against the US dollar, taking into account factors such as interest rate differentials, economic data releases, and geopolitical developments. A walkthrough of major currency pairs based on the trade volume, high to low. Currency pair. Brief description. Euro to US dollar. The most traded currency pair, representing the euro against the US dollar, reflecting the economic dynamics between the Eurozone and the United States. US dollar to Japanese yen. Reflects the exchange rate between the US dollar and the Japanese yen, influenced by economic indicators and geopolitical events, with the yen often considered a safe haven currency. Pound sterling to US dollar. Known as cable, it represents the exchange rate between the British pound and the US dollar, reflecting economic developments in both the UK and the US. US dollar to Swiss franc. Represents the exchange rate between the US dollar and the Swiss franc, influenced by global economic stability and safe haven demand for the Swiss franc. US dollar to Canadian dollar. Reflects the exchange rate between the US dollar and the Canadian dollar, influenced by oil prices, economic data, and interest rate differentials between the two countries. Australian dollar to US dollar. Represents the exchange rate between the Australian dollar and the US dollar, influenced by commodity prices, economic data, and interest rate differentials. NZD/USD. Reflects the exchange rate between the New Zealand dollar and the US dollar, influenced by commodity prices, economic data, and market sentiment towards risk. Euro to pound sterling. Reflects the exchange rate between the euro and the British pound, representing economic dynamics between the Eurozone and the UK. Euro to Japanese yen. Represents the exchange rate between the euro and the Japanese yen, influenced by economic indicators, interest rate differentials, and geopolitical events. Pound sterling to Japanese yen reflects the exchange rate between the British pound and the Japanese yen, influenced by economic developments in the UK and Japan and market sentiment towards risk. Euro to Swiss franc represents the exchange rate between the euro and the Swiss franc, influenced by global economic stability and market sentiment towards risk. Pound sterling to Swiss franc reflects the exchange rate between the British pound and the Swiss franc, influenced by economic developments in the UK, Switzerland, and market sentiment towards risk. US dollar to Hong Kong dollar represents the exchange rate between the US dollar and the Hong Kong dollar, influenced by economic data, interest rate differentials, and geopolitical events affecting Hong Kong. Euro to Canadian dollar reflects the exchange rate between the euro and the Canadian dollar, influenced by economic developments in the Eurozone and Canada, as well as commodity prices and interest rate differentials. Australian dollar to Japanese yen represents the exchange rate between the Australian dollar and the Japanese yen, influenced by economic indicators, commodity prices, and market sentiment towards risk. Pound sterling to Australian dollar reflects the exchange rate between the British pound and the Australian dollar, influenced by economic developments in the UK and Australia, as well as commodity prices and market sentiment. Euro to Australian dollar represents the exchange rate between the euro and the Australian dollar, influenced by economic dynamics in the Eurozone and Australia, commodity prices, and market sentiment. EUR/NZD reflects the exchange rate between the euro and the New Zealand dollar, influenced by economic developments in the Eurozone and New Zealand, commodity prices, and market sentiment. AUD/NZD represents the exchange rate between the Australian dollar and the New Zealand dollar, influenced by economic indicators, commodity prices, and market sentiment towards risk. USD/SGD reflects the exchange rate between the US dollar and the Singapore dollar, influenced by economic data, monetary policy decisions, and geopolitical developments in the region. US dollar to Mexican peso represents the exchange rate between the US dollar and the Mexican peso, influenced by economic indicators, political developments, and trade relations between the US and Mexico. US dollar to Swedish krona reflects the exchange rate between the US dollar and the Swedish krona, influenced by economic data, interest rate differentials, and geopolitical developments affecting Sweden. US dollar to Norwegian krone represents the exchange rate between the US dollar and the Norwegian krone, influenced by economic data, oil prices, and geopolitical developments affecting Norway. USD/DKK reflects the exchange rate between the US dollar and the Danish krone, influenced by economic data, interest rate differentials, and geopolitical developments affecting Denmark. USD/ZAR represents the exchange rate between the US dollar and the South African rand, influenced by economic indicators, commodity prices, and geopolitical developments in South Africa. USD/TRY reflects the exchange rate between the US dollar and the Turkish lira, influenced by economic data, political stability, and geopolitical developments affecting Turkey. US dollar to Indian rupee represents the exchange rate between the US dollar and the Indian rupee, influenced by economic data, interest rate differentials, and geopolitical developments affecting India. USD/BRL reflects the exchange rate between the US dollar and the Brazilian real, influenced by economic indicators, political developments, and commodity prices in Brazil. USD/RUB represents the exchange rate between the US dollar and the Russian ruble, influenced by economic indicators, geopolitical developments, and commodity prices in Russia. USD/PLN reflects the exchange rate between the US dollar and the Polish zloty, influenced by economic data, interest rate differentials, and geopolitical developments affecting Poland. USD/HUF represents the exchange rate between the US dollar and the Hungarian forint, influenced by economic indicators, interest rate differentials, and geopolitical developments affecting Hungary. USD/CZK reflects the exchange rate between the US dollar and the Czech koruna, influenced by economic data, interest rate differentials, and geopolitical developments affecting the Czech Republic. USD/THB represents the exchange rate between the US dollar and the Thai baht, influenced by economic indicators, tourism, and geopolitical developments in Thailand. USD/IDR reflects the exchange rate between the US dollar and the Indonesian rupiah, influenced by economic data, trade relations, and geopolitical developments affecting Indonesia. USD/MYR represents the exchange rate between the US dollar and the Malaysian ringgit, influenced by economic indicators, commodity prices, and geopolitical developments in Malaysia. USD/TWD reflects the exchange rate between the US dollar and the Taiwan dollar, influenced by economic data, trade relations, and geopolitical developments affecting Taiwan. US dollar to Argentine peso represents the exchange rate between the US dollar and the Argentine peso, influenced by economic indicators, political developments, and market sentiment towards Argentina. US dollar to Chilean peso reflects the exchange rate between the US dollar and the Chilean peso, influenced by economic indicators, political stability, and commodity prices in Chile.
Dòlars americans COP
Represents the exchange rate between the US dollar and the Colombian peso, influenced by economic indicators, political developments, and commodity prices in Colombia. USD/PEN reflects the exchange rate between the US dollar and the Peruvian sol, influenced by economic indicators, political stability, and commodity prices in Peru. Relationship 1. Oil, yen, and loonie. Introduction. The relationship between oil prices and currency values, particularly the Japanese yen, JPY, and the Canadian dollar, CAD, holds significant importance in the Forex market. Historically, there has been a positive correlation between oil prices and the CAD, given Canada's status as a major oil exporter. Conversely, the JPY typically exhibits a negative correlation with oil prices due to Japan's reliance on oil imports and its status as a safe haven currency. Understanding these correlations can empower traders to make informed decisions, leveraging the fluctuations in oil prices to anticipate movements in the Canadian dollar to Japanese yen currency pair. Additionally, considering other economic factors and geopolitical events alongside oil price dynamics is crucial for a comprehensive analysis of currency fluctuations. What you will get after reading it. Relationship. Oil and the loonie, CAD. Oil and the yen, JPY. Correlation. Positive. Negative. Reasoning. Canada is a major oil exporter. Higher oil prices boost CAD. Japan is a major oil importer. Higher oil prices weaken JPY. Weaker correlation recently. Yes.
No.
Additional influences. Interest rates. Economic health. Safe haven status. Economic stability indicators. A breakdown of the relationship between oil, the Japanese yen, JPY, and the Canadian dollar, CAD, also nicknamed the loonie, to help traders analyze market situations. Oil and the loonie, CAD. Positive correlation. Historically, there's been a positive correlation between oil prices and the loonie. This means that when oil prices go up, the loonie tends to strengthen, and vice versa. Reasoning. Canada is a major oil exporter. When oil prices rise, Canada earns more from its exports, which strengthens the demand for loonies. Weaker correlation recently. While the correlation exists, it has weakened in recent years. Other factors like interest rates and overall economic health can now play a bigger role in the loonie's value. Oil and the yen, JPY. Negative correlation. Generally, there's a negative correlation between oil prices and the yen. This means that when oil prices go up, the yen tends to weaken, and vice versa. Reasoning. Japan is a major oil importer. Higher oil prices mean Japan has to spend more on imports, weakening the yen. The yen is also considered a safe haven currency during economic uncertainty. When oil prices rise, it can signal economic instability, causing investors to seek yen as a safe investment, further weakening it. How this helps traders. Understanding the relationships. By understanding these correlations, traders can potentially make informed decisions. For instance, if oil prices are rising, a trader might consider buying the loonie, CAD, in anticipation of its value increasing. Conversely, they might sell the yen, JPY, expecting it to weaken. Not the only factor. It's important to remember that these correlations are not absolute and shouldn't be the only factors considered. Other economic data, global events, and market sentiment can all play a role in currency fluctuations. Relationship between Canadian dollar to Japanese yen. The Canadian dollar to Japanese yen currency pair reflects the exchange rate between the Canadian dollar, CAD, and the Japanese yen, JPY. Here's how their relationship ties in with the dynamics of oil prices. Historically, Canadian dollar to Japanese yen tends to have a positive correlation with oil prices. When oil prices rise, the Canadian dollar, CAD, typically strengthens due to Canada's significant oil exports. Concurrently, the Japanese yen, JPY, may weaken as higher oil prices indicate increased global economic activity, reducing demand for safe haven currencies like the yen. Conversely, when oil prices fall, the CAD may weaken while the JPY strengthens. Lower oil prices can signal economic slowdown or instability, prompting investors to seek safety in assets denominated in yen, thereby strengthening the JPY against the CAD. However, while this correlation exists, traders should also consider other factors such as interest rate differentials, economic data releases, geopolitical events, and market sentiment when analyzing the Canadian dollar to Japanese yen pair. These additional factors can influence the currency pair's movements independently of oil price fluctuations. Time frames to watch for. Currency pair. Best time to trade, London time. Canadian dollar to Japanese yen. 8 to 1700 hours. Overlap between London and Tokyo sessions. During this time, traders can benefit from increased liquidity and volatility, especially when both the London and Tokyo sessions are active. Canadian dollar to Japanese yen. 12 to 1600 hours. Overlap between London and New York sessions. This period often sees heightened trading activity as both major financial centers are open, providing ample opportunities for traders to capitalize on fluctuations in oil prices and their impact on the CAD and JPY. Canadian dollar to Japanese yen. 14 to 1700 hours. Overlap between Tokyo and New York sessions. Traders can take advantage of increased market participation and liquidity during this overlap, particularly as it coincides with the release of economic data and news announcements that may influence oil prices and currency movements. Canadian dollar to Japanese yen. 2 to 4 o'clock. London session. Although the London session is relatively quieter compared to the overlap periods, traders can still find opportunities to trade Canadian dollar to Japanese yen, especially during the early hours when market sentiment is often established for the day. Canadian dollar to Japanese yen. Wednesday 15:30, 1600 hours. Release of EIA crude oil inventory report, asterisk. Traders may observe increased volatility and trading activity around the release of the EIA crude oil inventory report, which occurs every Wednesday. This can impact oil prices and subsequently influence the Canadian dollar to Japanese yen currency pair. Relationship 2. Gold and Greenback. Introduction. Understanding the relationship between gold prices and the US dollar, USD, is crucial for Forex market traders because it offers a valuable tool for anticipating market movements. Historically, an inverse correlation exists, meaning when the USD strengthens, increases in value, gold prices tend to weaken, and vice versa. This dynamic interplay goes beyond coincidence and is rooted in several key factors. Safe haven status. Gold is widely considered a safe haven asset. During periods of economic uncertainty or geopolitical tension, investors flock to gold as a reliable store of value. This increased demand pushes gold prices higher. Conversely, when the USD is seen as a safe haven, due to the relative stability of the US economy, investors may favor the greenback over gold, putting downward pressure on gold prices. Dollar-denominated pricing. The price of gold is most often quoted in US dollars. When the USD strengthens, it becomes more expensive to buy gold for investors holding other currencies. This dampens demand for gold, leading to a potential price decrease. Conversely, a weakening USD makes gold more affordable for foreign investors, potentially boosting demand and driving prices up. Interest rates. The Federal Reserve's interest rate decisions significantly impact the USD's attractiveness. Higher interest rates in the U.S. make dollar-denominated assets, like U.S. Treasury bonds, more appealing to investors. This can draw investment away from gold, potentially leading to a price decline. By understanding these core reasons behind the inverse correlation, Forex traders can gain valuable insights. For instance, if the USD strengthens due to rising interest rates, it might be a good opportunity to short gold, bet on its price going down, while potentially profiting from a long USD position, betting on the USD's value increasing. Gold and the greenback, USD. Inverse correlation. Historically, there's been an inverse correlation between gold prices and the USD. When the USD strengthens, gold prices typically weaken, and vice versa. Reasoning: gold is often seen as a hedge against economic uncertainty and inflation, making it attractive to investors during times of market volatility. Conversely, the USD tends to strengthen during periods of economic stability and growth, leading to an inverse relationship with gold. Additional influences. While the inverse correlation between gold and the USD is significant, other factors such as interest rates, geopolitical tensions, and central bank policies can also impact their relationship. How this helps traders. Understanding the relationships. By understanding the inverse correlation between gold and the greenback, traders can make informed decisions. For instance, if the USD is strengthening, traders may anticipate a potential decline in gold prices and adjust their trading strategies accordingly. Not the only factor. While the relationship between gold and the USD is essential, traders should also consider other factors such as market sentiment, economic data releases, and geopolitical events when analyzing gold prices and currency movements. Relationship between gold and greenback, USD. The relationship between gold and the greenback, USD, is complex but significant for traders. Historically, gold has served as a safe haven asset, often sought after during times of economic uncertainty or geopolitical turmoil. Conversely, the USD's strength is typically associated with economic stability and growth. When the USD strengthens, investors may flock to dollar-denominated assets, causing gold prices to decline. Conversely, when the USD weakens, gold prices may rise as investors seek alternative stores of value. However, it's essential to note that this relationship can be influenced by various factors, including central bank policies, inflation expectations, and market sentiment. Time frame, London time.
Description.
Benefit for traders: 8 to 1700 hours. Overlap between London and New York sessions. Increased liquidity and volatility: 12 to 1600 hours. Peak overlap between London and New York sessions. Heightened trading activity and fluctuations: 2 to 4 o'clock. London session. Establish market sentiment and early opportunities. Anytime. 24-hour market. Capitalize on unexpected events.